Good morning. Today we're going to look at uh, journal entries. Journal entries. Okay, the first step in the accounting equation is to record and analyze the accounting transactions. So the first step is analyzing transactions. So analyzing transactions here, we look at how the transactions affect the accounting equation. So this is basically effect on accounting equation. It is a subject that we looked at last time. We saw how, for instance, when you buy an asset, how the accounting equation can be affected. And we saw that the accounting equation must always be balanced. Today, we're going to look at the second stage in the accounting process, which is to pass journal entries, what to debit and what to credit. It is a confusing thing for many people, but it is very simple. Okay, so I'm going to give you a matrix that you're going to use that will guide you in how to know what to debit and what to credit. Right. So first, this is the accounting equation. Asset is equal to capital plus liability. We say that assets and future economic uh, are, are, are future economic benefits or things that can make you derive future economic benefits. Capital is owner's equity or owner's investment. Liabilities are the obligations. So the matrix that is going to guide us in this topic is this one. If an asset increases, we debit. If an asset increases, we debit. And then on this side, if the right-hand side increases, we credit. Okay. So if the left side increases, we debit. If the right-hand side increases, we credit. So this is a rule, and vice versa. So let me write here, and vice versa. So basically, what I'm trying to say here is that when asset decreases, now we credit. When an asset decreases, we credit. Okay? And when liabilities decrease, we debit now. Okay. Now, that is what we mean by vice versa. When an asset increases, we debit. When an asset decreases, now we credit. When a liability increases, we credit. When a liability decreases, we debit. Now, when it comes to expenses and revenue, when an expense, under capital or owner's equity, we say that what affects capital and owner's equity inside here is we have here expenses and revenue. These are the things that mostly affect capital or owner's equity. Now, when an expense increases, When an expense increases, we debit. I'm going to tell you the reason. And when a revenue increases, we credit. Now, this is how it works. Revenues have a positive effect on the owner's equity. Expenses have a negative effect on owner's equity. So it means when revenue increases, then capital may increase, and then we will have to credit the account. I don't know whether you got that one. Let me take it up again. Revenue increases capital or owner's equity. And when owner's equity increases, it is a credit entry. We are expected to do a credit entry. So by implication, it means that for every revenue, there's an increase in capital, and for every increase in capital, there is a credit entry. On the contrary, for expenses reduce capital, and for every reduction of capital, there's a debit entry. So let me do it like this. Expenses reduces. Uh, Let me use this figure, capital. And a reduction of capital should be debited. Revenues increases capital. And for every increase in capital, we credit. So what we are learning today is that we handle expenses and revenue with regard to how they affect capital. If expenses decrease capital, then now we don't apply this matrix, but it's reverse. Revenue increases capital, and so if capital increases, we credit. So in turn, what we're saying, we debit expenses and we credit revenues because of how they affect the accounting element of capital in the accounting equation. So this accounting equation, this matrix is like a Bible in accounting. If you know how to handle asset increase or decrease, you're set. If you know how to handle liabilities increase, you do this. Decrease, vice versa. If you know how to handle capital and the things that affect capital, yeah. So if it is a revenue or a sales, then you know that sales increase capital, and any increase we credit. Expenses decrease capital, and any decrease we debit. So that would be our guiding principle in this lesson. So let us start with an example. You bought a computer in in cash. So let us say you bought a computer. Let me wrap this and put it at the end. So this is our matrix. Asset is equal to capital plus liability. This one is debit. Then on that side we credit. So number one, so example, purchase of computer in cash. Okay, so if you purchase a computer in cash, how do we analyze this transaction? So the first step in the journal entry is to analyze. So the first step is analyze. If you analyze this purchase of computer in cash, you will find that asset account will go down because cash has gone down. So it will be like this. Your analysis will be like this. Asset goes down to cash. Okay. Let me say this computer is 30K. Asset goes down by 30K. At the same time, asset goes up by 30K through computer because computer is an asset. So asset also goes up through computer. So let me write this computer. So you have your cash, you have your computer, which has also gone up by 30,000. So your assets have remained at the same level. So the right hand side and the left hand side balances. So this accounting equation balances. So that is fine. Now, how will you pass the journal entry now after analyzing? So the second step is journal entry. Journal entry is about which account to debit, which account to do what? To credit. Right. Now, this is what we will do. If an asset increases with debit, so there's an asset which has increased. So that is what? Computer. So we should debit the computer account. Right. So we come here, we look at the date that this transaction took place. You can add transaction number. You can add account. You can add description. You can have debit, credit. So this date we are not given. Transaction number, let me say it is the first transaction. The account that we are dealing with now is computer account. Computer account. The description is purchase of computer. So this is purchase of computer. And then we will have this an increase. The computer increased asset. So it will be 30,000. Okay. Then another asset has gone down, which is cash. If asset goes down, now we don't debit that account, but we credit it. So it will be like this. The date is the same, though we don't know it. Transaction number is the same. The account now is cash. Come here, cash. The description is the same, purchase of computer, but now the cash account, we don't debit it, we credit it. So here will be 30,000. Okay, so this is an example of a journal entry. You have seen how we have applied the principle of double entry, the concept of double entry, which mimics Newton's third law of motion. For every action, there's an equal and opposite reaction. Just like in accounting, you've seen that for every debit, there has to be a credit, and for every positive effect, there has to be a negative effect. So basically, this is how we are going to do journal entry. This is a good example of a journal entry. So let us give an example with an expense. So grab this. Grab that, and then we're going to look at expense. Okay, so you paid rent expense of 5,000 in cash. You paid in cash. So the first stage is analyze. Asset is equal to capital plus liability. So rent expense in cash. Your cash will make your asset to go down. So cash has gone down, therefore asset has gone down by 5,000. Your capital has been affected because expenses affect capital, but they affect capital negatively. So here you will have rent expense of 5,000. So the effect on the right hand side and the effect on the left hand side have have balanced. So the accounting equation has balanced. So the next step is journal entry. Journal entry. So for this journal entry, we will have date, transaction number, account, description, debit, credit. Okay. Now date we're not given, transaction number, let me say it is number 2. Account. Now the first account is cash. When cash, when an asset goes up with debit, but in this case asset has gone down. So the account which is cash, we are not now going to debit it, we're going to credit it by 5,000. And the rent expense has made capital to go down. So when capital goes down, now we debit. But we don't debit capital account, we debit rent expense account. So get that one very clearly. We debit the specific account, not the accounting element. Like in this case, we didn't debit asset account, we debited cash account. So in this case, we don't debit capital account, we debit rent expense account. So the transaction number is the same, rent expense. I didn't write the description, so this could be payment of rent. Payment of rent on such and such a day. You can add the day, and then it is a debit now. So it's a debit of 5,000, and your debit and your credit balances are equal. So basically, this is how we do journal entries. You analyze and you pass the journal entry according to this accounting equation. For every increase in asset, you debit. For every increase in the other side, you credit, and vice versa. And so that rule is important. It is like the Bible in accounting. It applies everywhere. It is the foundation stone. If you get this right, accounting will be very easy, and all the other steps are building on this, including the financial statements that we're going to produce. So this is the end of our lesson. Have a good day, and God bless you.